Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Oklo.
If you find our talks useful, please consider subscribe, like, and comment underneath. And before we jump into things, definitely check out the VIP Algos link below in the description. That's got our full affiliate disclosure, to help support what we do here.
Yeah, absolutely. Check that out.
So setting the stage for today, if you look at the entire tech landscape right now, it's kind of wild. We are basically building the most massive, power-hungry artificial brains in human history with AI. But there's this one fundamental problem.
We literally don't have the electricity to turn them on.
Right. The grid is completely tapped out. So tech companies are just desperately hunting for alternative power sources. And that brings us to Oklo. They're an advanced nuclear energy company positioned right in the middle of this whole crisis.
Exactly. But there's a massive tension here that we need to unpack for everyone.
Yeah, the valuation.
Right. So Oklo is currently valued by the market at roughly $8 billion. $8 billion.
Insane.
But they are entirely pre-revenue. I mean, they haven't sold a single watt of electricity yet.
$0 coming in.
Zero. And, in a sector that is just infamous for decades of regulatory red tape, you have to wonder, why on earth is anyone paying an $8 billion premium for a company making exactly $0?
Right, which goes into the whole wealth-building context of this. Like, how do you even evaluate a business like that? Because if you're looking for traditional quarter-over-quarter growth, you're in the wrong place.
Oh, totally. You have to completely shift your mindset. It's basically a binary outcome.
Right, an asymmetric bet.
Exactly. If they fail to get the regulatory approvals they need for their tech, the intrinsic value of this company basically trends to zero. It just evaporates. But on the flip side, if they navigate all those hurdles and actually commercialize, they essentially have a functional monopoly on a huge chunk of the future global energy grid. So investors who are stomaching that $8 billion valuation right now, they're not buying current cash flow. They're buying like a VIP ticket to what the world's energy infrastructure might look like in 2030.
Right. But before we get into the crazy swings in their stock price, and it has been a brutal roller coaster, we should probably clarify what they're actually building. Because I think when most people hear nuclear power, they immediately picture those giant, sprawling 1970s plants, right?
Oh, yeah. The massive concrete cooling towers by a river. The whole Homer Simpson vibe.
Exactly. But that is not what Oklo is doing at all. They are building small modular reactors, SMRs, or specifically they call it the Aurora Powerhouse.
Yeah, the Aurora design is, it's fundamentally a completely different approach to nuclear fission. And understanding the mechanics is pretty crucial to getting their business model.
Right, because traditional plants use pressurized water, right?
Exactly. They use water to cool the reactor core. But the issue with water is that under insane heat, it desperately wants to turn into steam and expand.
Which is bad.
Right. So to stop a massive explosion if something goes sideways, you have to build those gigantic, multi-billion-dollar concrete containment domes.
Yeah.
But Oklo's Aurora design, it just sidesteps that entirely. It's a fast fission reactor, and it uses liquid metal for cooling.
Specifically liquid sodium, right?
Right. Liquid sodium.
Which, from what I understand, transfers heat incredibly efficiently, but more importantly, it doesn't need to be pressurized like water does.
That is the absolute key right there, because it operates at just like normal atmospheric pressure. That risk of a massive pressure explosion, it just vanishes.
Wow.
Yeah, so you don't need the giant concrete dome anymore. You can shrink the entire footprint of the power plant down to, honestly, something the size of an A-frame cabin.
That's wild. Just an A-frame cabin powering a data center.
Exactly. And because it's so small, you aren't spending a decade building it on site. You can literally manufacture the parts in a factory, put them on a standard flatbed truck, and assemble it right next to the data center that needs the juice.
Okay, so that explains the hardware fundamentals. But building it is like only half the battle. The other half is actually getting permission from the government to turn the thing on.
Right. The regulatory nightmare.
Yeah, they're in the middle of this combined license application at COLA with the Nuclear Regulatory Commission, the NRC. But the NRC is used to looking at those giant 1970s water reactors. I mean, rolling up with a liquid sodium fast reactor has to throw them for a loop.
Oh, it's a massive hurdle. And look, safety is rightfully the NRC's only priority here. But if you look at it from a business perspective, that sluggish, painful regulatory process, it's actually Oklo's greatest competitive moat.
Wait, really? The red tape is a moat?
Yeah, think about it like getting FDA approval for a groundbreaking new drug. It takes years of trials, costs an absolute fortune, and the outcome is totally uncertain. But the second you get that approval, you've got an impenetrable fortress around your product. If Oklo secures the COA, they're the first mover in commercial advanced fission.
So if a competitor wants to copy them, they can't just spin up a startup in a garage.
Exactly. They have to go all the way to the back of the NRC line and spend 5 years and millions of dollars proving their own safety case.
That makes a lot of sense. And it's not like Oklo is just sitting around twiddling their thumbs while they wait in that line. Looking at the recent fundamentals, there was a pretty aggressive strategic move recently. Back on June 30th, they acquired a company called Creative Engineers. CEI.
Yeah, CEI. They are a firm with incredibly specialized expertise in sodium and alkali metal systems.
Right.
Because, like, handling liquid sodium is, it's not standard plumbing.
Definitely not.
It's super volatile if it hits water or air. It requires crazy specific chemical process engineering. So by buying CEI, Oklo is bringing all that rare component fabrication expertise entirely in-house.
Which honestly feels less like a typical tech buyout and more like a defensive play to just starve out their competitors.
Oh, 100%.
Right. Because there just aren't that many engineers on the planet who specialize in commercial sodium systems. By absorbing CEI, Oklo basically locks up the talent pool. They speed up their own timeline, sure, but they drastically raise the barrier to entry for anyone else trying to build a sodium reactor.
It creates a massive intellectual property barrier. They are vertically integrating the hardest part of their supply chain, so now they control their own destiny, rather than, relying on some external contractor who might also be taking calls from rival startups.
Right. But maintaining a roster of specialized nuclear scientists and absorbing an entire engineering firm is incredibly expensive. Which brings us to the reality of their balance sheet.
Yeah, the cash burn.
Right. Building this regulatory moat takes heavy capital, and they have exactly zero revenue to offset it.
The financials really show the stark reality of pioneering a totally new physical industry. Over the trailing 12 months, Oklo has a negative EPS of minus 83 cents roughly. They were just burning through cash, pouring every single dollar into R&D and trying to navigate that NRC labyrinth.
Yet, despite that crazy cash burn, they're maintaining that $8 billion market cap. They're trading at a price-to-book ratio of just over 3.0. So the market is valuing them at over 3 times the worth of their actual physical assets.
Which is actually surprisingly solid for a pre-revenue hardware company. It just shows that investors are putting a massive premium on their intangible assets.
Right, the IP, the CEI talent, the regulatory progress.
Exactly.
But let's give it to the technicals for a second, because the public market's patience, it really seems to be wearing thin. The stock right now is trading at $46.24.
Yeah.
Sure, it's up a tiny bit on the day, but if you zoom out, the chart is just ugly. It's been in a brutal, prolonged downtrend, down over 35% year to date. But the real shocker, it is down 76.1% from its 52-week high of $193.84.
Ouch. Yeah, a 76% drawdown is severe.
Yeah, that was back in October.
Right.
Yeah.
It completely shakes out anyone who bought into the initial hype, hoping for a quick flip. But from a technical analysis standpoint, the current behavior is actually really telling. The stock is holding just above its 52-week low of $44.88.
Okay.
And if you look at the trading volume, it's contracting heavily. It's running at about 0.69 times its 3-month average right now.
Meaning, basically, the selling pressure is exhausting itself. Like, whoever wanted to panic sell has already dumped their bags.
Precisely. When the price just hovers near a major low, but the volume totally dries up, it usually signals a bottoming process.
Yeah.
The market is trying to establish a floor here, but that floor is only going to hold if the institutional conviction is actually there.
And man, that institutional sentiment is where the data gets so contradictory. It's fascinating. If you're a listener looking at this stock, trying to make sense of a 76% drop, you'd probably look at what the insiders are doing to gauge confidence, right? Well, over the past 90 days, insiders at Oklo have been massive net sellers. They've unloaded 1.29 million shares. That's 51 sell transactions compared to only 16 buys.
Wow.
Yeah. I mean, if the actual people building this technology are dumping their shares near the 52-week low, doesn't that flash a massive red warning light?
It is definitely a red flag, but you have to look at the context. Insider selling is inherently messy. Executives sell for all sorts of reasons that have nothing to do with how the company is actually doing.
Like taxes.
Exactly, paying taxes on vested options. Or maybe they just need to diversify because their entire net worth is tied up in one super risky asset. Or they're buying a house. But you can't ignore the volume. 1.29 million shares is significant.
Right, it's not just a little trim.
No.
Yeah.
It suggests that, at the very least, insiders don't expect the stock to randomly rocket back to 190 tomorrow. They are perfectly willing to take the cash at these depressed levels.
But then you look at the exact opposite side of the trade, and you have these massive institutional giants stepping in. Specifically, Cathie Wood's ARK Invest. They recently scooped up 100,854 shares of Oklo, which is roughly a $4.7 million injection into the stock.
And this is exactly the tug-of-war that makes Oklo such an incredible case study right now. While insiders might sell for 50 different personal reasons, institutional funds like ARK, they really only buy for one reason.
You make money.
Right. They believe the asset is fundamentally mispriced and will go up over their time frame. And ARK is famous for doing super deep, specialized research into disruptive tech. So for them to deploy millions of dollars after a 76% crash, they don't view this as a failing business. They view it as a de-risked entry point. They are essentially soaking up all those shares that retail investors and insiders are dumping.
Interesting. And the broader analyst sentiment is trying to thread the needle between those two extremes. Truist Securities just recently initiated coverage. They slapped a hold rating on it, but, and this is the key part, they gave it a $55 price target.
Yeah, the target is way more important than the rating in this case. A $55 target on a stock sitting around 46 implies, what, a 19% upside?
Yeah, roughly 19%.
Right. So a hold rating from them basically just means, hey, we don't see an immediate catalyst that's going to make this thing break out next week, but their fundamental valuation model still points upward.
But for Oklo to actually break that downtrend and hit that 55 target, they need concrete catalysts. I mean, a stock doesn't rally 19% just because it stopped going down.
Right.
You know,
Hey,
you need a spark.
So what's actually on the horizon here?
Well, looking at the catalysts in the near term, like the next 3 months, the market is laser focused on a couple of things. First, the upcoming earnings call. Now, obviously, nobody's expecting revenue.
Right, $0.
Right. But all the attention is going to be on the CEI acquisition updates.
Yeah.
Analysts want to see proof that integrating those sodium engineers is actually accelerating the Aurora timeline.
Makes sense. And second, and this is the big one, the market is just absolutely starved for any update from the NRC regarding the CECL layer review process. Even a boring procedural update that just shows the regulators are moving forward could be a massive upside catalyst.
Okay, so that's the company-specific stuff. But what about the macro catalysts? Because there are some massive tailwinds right now. You've got severe geopolitical energy tensions like potential disruptions in the Strait of Hormuz.
Oh, absolutely. Whenever global oil and gas supply chains look vulnerable, suddenly domestic, clean, baseload nuclear power isn't just an environmental talking point anymore. It becomes a matter of strict national security.
Exactly. And you're seeing that compound with domestic infrastructure spending. Like, look at New Jersey. They recently unveiled a $24 billion state-level nuclear opportunity. Now, I know current sentiment leans toward established legacy players for those early state contracts, like Westinghouse AP1000 Tech.
Sure, governments usually play it safe with legacy tech first.
Right, but just the fact that a $24 billion state initiative exists, it completely validates the market size. Even if Oklo doesn't get that specific bid, it proves the capital is just waiting there to be deployed. The second SMR technology is proven.
Oh, 100%.
But let's talk about the elephant in the room. The biggest macro catalyst of all, which also happens to be the source of their biggest risk. Artificial intelligence.
Yes.
Data centers need an uninterrupted power supply.
The demand curve from AI is just unprecedented right now. A data center running advanced language models requires exponentially more power than, say, a standard cloud storage facility from 5 years ago.
Right.
And as great as wind and solar are, they are intermittent. AI requires baseload power and needs energy flowing 24/7, regardless of if the sun is shining or the wind is blowing. Nuclear is quite literally the only carbon-free solution that fits that exact profile.
Okay, I have to push back on the risk side of this, though, the timeline mismatch.
Yeah, let's hear it.
We constantly hear that AI data centers need immense power today. They are plugging in GPUs as fast as the supply chain can physically deliver them. But nuclear commercialization, even if Oklo gets NRC approval tomorrow and their factory production scales flawlessly, is still years away.
Yeah.
Are investors dangerously misaligning these timelines? Like, are we trying to solve an energy crisis that's happening right now in 2026 with a reactor that might not actually flip a switch until 2032?
That is the structural flaw in this entire hype cycle. And honestly, it is the primary bear case for this stock. The timelines just absolutely do not align for short-term relief.
Right.
Oklo cannot solve the grid constraints happening this year or next year. Plus, their entire valuation rests on that NRC approval. If the regulators turn around and demand, major design revisions for the liquid sodium cooling system,
Oh, man.
or if the process just drags out for an extra 3 years, Oklo will be forced to raise more capital to survive. And if you have to raise cash at depressed stock prices, you are heavily diluting your current shareholders.
And if the broader market continues to rotate away from speculative clean energy plays, Oklo could easily break right through that $44 support level and just find entirely new lows.
Exactly. The downside risk is very, very real.
Okay, so let's pull all this together for the final verdict. We've got an $8 billion valuation on a pre-revenue company. We have insiders cashing out while smart money institutions like ARK double down. We've got this revolutionary liquid sodium tech waiting on regulators who are used to the 1970s. And we have this massive timeline mismatch between AI's immediate need for power and nuclear's slow development cycle.
It's a lot to weigh.
Yeah, so where does the final rating land on this for the listener's own research?
So the overall analysis ultimately gives this a bullish score of 7 out of 10.
7 out of 10, okay.
Yeah, it's framed as a high-conviction, asymmetric entry point. But with a massive caveat. This is strictly for risk-tolerant capital. They recommend looking at an 18 to 36-month holding horizon.
So not a quick trade?
Not at all. You are not trading immediate momentum here. You are positioning yourself for the eventual transition from R&D to full commercialization. That CEI acquisition really shores up their technical moat, and the institutional buying provides a decent floor, but you have to be willing to stomach the volatility of this regulatory waiting game.
Yeah, it requires a completely different mindset. You are investing in heavy physical infrastructure that could literally redefine the global energy grid. This isn't a software company that can just patch a bug overnight and push an update.
Right.
If you're looking at Oklo, you have to accept that your capital is tied up in a regulatory waiting room. But if they do get the green light, they have the IP and the specialized talent to scale an entirely new type of energy production.
Exactly. I mean, the tech giants are playing a multi-decade game here. They know the current grid can barely handle today's AI, let alone the models that are going to drop in the 2030s. So they view the current delay in SMR commercialization not as a deal breaker, but just as a necessary bridge they have to cross for permanent, scalable energy independence.
Which leaves us with a final, somewhat provocative thought to mull over. We know how desperate Microsoft, Google, Amazon, all of them are, for clean baseload power to run these massive AI data centers. Right now, they're just signing huge power purchase agreements with traditional utility companies. But if small modular reactors like Oklo's Aurora eventually become the only viable deployable backbone to power the next generation of AI, are we looking at a future where these tech giants simply bypass the traditional energy grid entirely? As AI energy demands scale to levels that traditional utilities literally cannot support, the line between what constitutes a technology company and what constitutes a utility company might just disappear completely.
That's a crazy thought.
Right. The tech giants might not just be buying the power anymore. They might have to buy the reactor companies outright just to ensure the lights stay on.
Definitely something to keep an eye on over the next few years.
Absolutely. Well, that wraps it up for today. Remember, if you find our talks useful, please consider subscribe, like, and comment underneath. And don't forget, the VIP Algos link is below in the description. Thanks for joining us on Smart Wealth with Joshua, and we'll catch you next time.